Welcome back. We've just been telling you how India has stock outperformer today. Yes, it's a 0.4% fall, but just put it in the global context. The manner in which the Nikkei has been falling, of course, that's a class apart with the yen strengthening. That's down about 2.25%. But Shanghai, Hang Seng, Taiwan, Korea, all of them about 0.6 to 1% lower. Relatively, Indian markets are down 0.4. Okay, Straits is also down just 0.2 at this juncture. And importantly, the mid-cap index is up about 0.5%. So does this market rally to 6,800 have more legs? Manishi Raychaudhuri of BNP Paribas Securities joins in to answer these and other questions. Manishi, that's the first question. Should yesterday's NASDAQ correction be seen just as one-off in an otherwise bullish equity markets globally? And how would you rate the bull rally in our own markets?
All right. So first of all, I think this global equity market correction that we are seeing right now, that was in essence long overdue. You know, there are certain markets in the world that had run ahead of their expectations. And possibly such valuation extremes, well, extremes is not exactly the right phrase to use, but pretty significant valuation premiums compared to history was more concentrated in the developed markets, particularly the United States. So that's the, that's the usual correction that we're seeing right now. And actually, the emerging markets, including India, are not free from that. But at the same time, the fundamental drivers for markets like India are strong, and therefore, it is outperforming by not falling to the extent that the other Asian and emerging market peers are doing. This is something that we had anticipated when we upgraded India to an overweight sometime in late February, I think about 25th or so. And we still retain that stance, even though since then, over the last 1.5 months or so, the market has rallied significantly. But we think that the fundamental steam that we had anticipated is not entirely blown off yet. You know, there's still some steam left, which would lead to further outperformance compared to Asian peers. It is clearly helping the case of India that some of the other larger Asian peers have pretty significant fundamental concerns associated with them. And I have China and Korea in mind. If you look at the last quarterly result season, it was absolutely disastrous for pockets of North Asia, particularly Korea. In case of China, we not only have concerns about growth slowdown, but also the concerns about some kind of a disruptive dismantling of the bank's asset quality that investors seem to be worried about. So all this is actually coming together to help the Indian equity market at this stage.
Okay. Manishi, hi, good morning. This is Sonia here. So if you still maintain your overweight on the Indian markets, what kind of returns do you think India could give by the end of the year?
All right. You see, from the current target that we have, which is about 24,000 on the Sensex, it may not sound like much, which is about 7 to 8% in a span of about 8 months. Yeah, so that's hardly about, maybe 12% over an annual period. But I must also mention that the expectations about a stronger and stable government and expectations about earnings outperforming or surprising positively, that seem to be gaining ground. And it seems to be happening in those sectors which have underperformed historically, particularly the domestic cyclicals, like banks, like industrials. In fact, industrials is one area where we think such expectations have increased and they're likely to continue going forward, even though the kind of kickstarting the investment cycle may actually take some time. It may not happen right now, maybe not over the next 6 to 9 months. But the markets move on expectations. They don't really move when the reality actually hits. They move significantly ahead of that. So I would think that there is a possibility of both earnings and valuations surprising positively going forward. So, I think we'll have to take a relook at that target as we go along. But going by the way things are panning out, we can have, anywhere between 12 to 15% returns on the market, even from the present elevated levels.
Oh, Okay. Well, you know, I was going to ask you a question, but then we have our money control viewers who can ask you, or users who can ask you their questions. It's quite similar, really. Right. Abhishek from Pune has written to us. He asks, which sectors or stocks will lead the next bull run, if indeed there is one? You're speaking about a 12 to 15% return even from current levels. So, which stocks can ensure that?
Absolutely. You know, I'll point out three sectors. I wouldn't exactly comment on stocks, but you know, one should focus on industrials, one should focus on private sector banks, and surprising as it may sound, one should also focus on IT, especially after the correction that we have had in that particular sector. And in each of these, I would rather you know, still focus on the larger and you know, relatively larger frontline names, which have 2 or 3 different characteristics. In case of the private sector banks, it should have a pretty significantly high CASA, or you know, a relatively low reliance on wholesale funding. Secondly, in case of industrials, I would look at relatively healthy balance sheets, low debt to equity ratio, relatively high interest coverage, and so on. And finally, for IT services, again, the relatively larger companies who are effectively demonstrating the ability to get new orders and new clients from the developed markets. You know, so I think those are the 3 sectors, and within them the sub-segments that investors should focus on.
Would you buy any of the momentum boys now, Manishi, in the infrastructure space, real estate space? A lot of these stocks like Adani Group, etc., just for a tactical run?
You see, for any investor, be it institutional or individual, it is very difficult to time these things. And you know, the kind of stocks that you mentioned, Adani, etc., there are reasons why they have appreciated over the last 6 months or so. These reasons are mostly political in nature. They're basically hope related. While I don't disagree with the rationale behind them, but at the same time it's very difficult to time them, you know, time the exact entry and exit points. And I would rather hope for more fundamental reasons to invest in stocks. So, you know, it's kind of a long-winded reply to your question, but I would not really chase any of those at the present point in time.
No PSU banks.
There is, you know, that universe we are playing very selectively. In fact, in the India model portfolio, there is one PSU bank that we added in early March, and that was the only one was Bank of Baroda. It was almost after 1.5 years, and we haven't had a PSU bank for the last 1.5 years prior to this. I think in case of PSU banks, not only would one have to focus on relatively better asset quality, but also on those banks whose capital requirement is relatively less than their peers. I think Bank of Baroda satisfies both.
Okay. Fair enough. It's one of the stocks in the green today as well, along with PNB. Other stocks are in the red. Manishi Raychaudhuri, we appreciate you taking time out for us. Thank you very much for joining us and speaking about all those sectors.